Welcome to the deep dive. We are kicking things off with what might be the most shocking investment story of 2025.
It's a big one.
I mean, picture this. Wall Street was caught completely flat-footed when a specialized defense ETF, SHLD, delivered a jaw-dropping 73% year-to-date return. It absolutely crushed its competitors.
And this isn't just a random spike. It's a real structural shift. We're going to unpack the $4.2 trillion NATO spending mandate that's fueling all of this.
Trillion with a T.
And we're going to expose the real secret here. Two stocks. One of them surged 321%, are responsible for basically the entire rally. You won't believe the concentration risk hiding in plain sight.
We're going to give you the exact playbook. What to buy, what to avoid, and why. Crucial mandatory introduction. You're with ChannelVest, your expert in ETF strategies. Stick around until the very end to find out if SHLD, ITA, or PPA belongs in your portfolio. This is insane.
Let's jump right in.
Okay, the title of our first section really sets the stage. SHLD's 153% rally. The defense tech bomb Wall Street didn't see coming.
This is pretty much our mission statement for this entire deep dive. We're here to analyze how SHLD pulled off that phenomenal 73% YTD return in 2025.
And why it left the traditional funds in the dust.
Exactly. We'll get into the NATO spending, that wild 321% surge from Palantir, and distill all this complex data so you can clearly decide, whether to buy SHLD, stick with the old guard like ITA, or just avoid the sector completely. This tech pivot is what Wall Street missed.
All right, before we get any deeper into those numbers, we absolutely have to cover the next section. It's the important disclaimer.
Yes, this is essential. Just so everyone is clear, we provide research and educational content only here at ChannelVest. We are not registered investment advisors or fiduciaries.
So this is not personalized advice for you.
Right. You have to consult a qualified advisor. And it's so important to understand the risks here. Defense investments carry significant dangers. There's geopolitical uncertainty, valuation risks, and what we're really focusing on today, extreme concentration risks.
Okay, disclaimer done. Let's get back to the numbers because the performance gap is just, it's shocking. Here's the next section. The brutal truth. SHLD destroyed traditional defense ETFs in 2025.
Okay, let's break this down. Year-to-date 2025, SHLD, the fund focused on defense technology, we're talking AI, drones, cyber delivered 73.38%.
And it only launched in late 2023, right? And it's already at over $5 billion in assets.
5.17 billion, yeah. Now compare that to the traditional funds. ITA, which is more about hardware like engines and missiles, returned 42.16%.
Still good, but not 73% good.
Not even close. And then you have PPA, the clear laggard, which only managed 31.86% while charging the highest fees.
So almost double the performance of PPA, but you said this is all driven by just two mega winners. That sounds like a huge red flag.
It is the defining insight. But first, let's set the stage with the macro tailwind that's lifting the whole sector. Next up, NATO's $4.2 trillion bombshell. That changed everything.
This really is the foundation for the whole argument, isn't it? All 32 NATO members have committed to a new target, 5% of their GDP on defense spending by 2035.
I mean, this is genuinely the biggest military spending mandate since the Cold War.
Yeah.
It's a game changer.
So what does that mean in dollar terms?
Well, right now, annual NATO budgets are around $1.4 trillion. To hit that 5% target, annual spending has to go over $2.8 trillion by 2035.
So that's an extra $1.4 trillion.
An extra $1.4 trillion. It's like adding another entire U.S. defense budget every single year. This is a guaranteed 10-year tailwind.
Okay, so that's the fuel. Now let's talk about the rock stars driving the returns. This next section is called Performance Exposed. The secret weapon is Palantir plus Rheinmetall.
And here is where that high-stakes concentration really comes into play. First up, Palantir, the AI software firm. It surged 321.61% year-to-date.
321%.
It makes up over 9% of SHLD's entire portfolio, and it's landing these huge contracts like a $10 billion deal with the U.S. Army.
And what's the second name?
That would be Rheinmetall, the German defense giant. It soared 255.76% and has a 7.21% weighting. They are just cleaning up on European rearmament. They have a 55 billion euro order backlog.
And if you compare that to a traditional player like RTX, which was up about 42%, the difference is just night and day.
Absolutely. The tech disruptors versus the old guard.
So let's dig into the math on that risk. Next up, continuation deep dive on math.
This is the part that's almost unbelievable when you see it. So Palantir and Rheinmetall combined, they're only 16.4% of SHLD's total portfolio weight.
Okay, 16.4%. Seems reasonable.
But listen to this. Those two stocks drove 48% of the fund's total 73.38% return.
Wait, say that again? Less than a fifth of the fund?
Yep.
Drove nearly half of all the profit.
That's exactly right. If you take those two stocks out of the equation, SHLD barely beats ITA. This is a textbook case of extreme concentration risk disguised as diversification.
So it's not diversification at all. It's a massive bet on just two companies.
A massive directional bet.
Okay, before we break down that structure more, we need to take a quick pause. The next section is Don't miss what's coming next.
Look, we are constantly breaking down complex strategies and research just like this, trying to make it simple and actionable for you.
We have so much more analysis coming up. We're talking option strategies to generate income, how to protect your portfolio from the next crash, the exact rebalancing triggers, you name it. So here's CTA 1.
Make sure you hit subscribe and turn on notifications for ChannelVest so you do not miss our upcoming research.
Now let's get back to the holdings battle. The next section is called the concentration paradox. 62% in top 10 stocks feature or bug.
So when we look at SHLD, 62% of its assets are in its top 10 holdings. And as you said, Palantir alone is almost 10% of the entire fund. That feels really risky.
It is risky, but it's an intentional risk. It's a feature, not a bug. SHLD is explicitly betting that defense technology, AI, and software is the future.
And that it will crush traditional hardware. Exactly. They have over 16% exposure to tech. ITA, on the other hand, it has a similar concentration in its top 10, but it's anchored by legacy companies like GE Aerospace. And crucially, it has 0% direct tech exposure. They missed the boat.
Okay, so let's pan out again to the bigger picture. Next section. Global defense spending, the $2.7 trillion elephant in the room.
Right. This just provides that macro context. Global military spending grew by 9.4% in 2024 to $2.72 trillion. That's the fastest growth in decades.
And the U.S. is still dominant, of course.
Oh, yeah, at nearly $1 trillion, about 37% of the global total. But China is catching up fast, spending over $300 billion with a huge focus on AI and cyber warfare.
But the real story here seems to be Europe. Their spending surged 17% in 2024. This isn't just a temporary thing, is it?
No way. Geopolitical tensions mean this spending is locked in for the foreseeable future. When you combine this with that NATO 5% target, we're looking at annual global spending easily topping $4.2 trillion by 2035.
With all that growth, you have to look at risk versus reward, which brings us to the next section. Risk-adjusted returns. SHLD's 3.56 Sharpe ratio is insane.
Okay, so for anyone who isn't familiar, what exactly is the Sharpe ratio?
Put simply, it's how much return you get for every unit of risk you take. And SHLD's 3.56 is, well, it's exceptional.
It's incredible. ITA, which is considered a stable fund, is way down at 2.04.
So what's the catch? Because a number that high never seems to last.
You hit the nail on the head. That amazing Sharpe ratio. It's almost entirely powered by Palantir, which had its own insane 6.92 Sharpe ratio.
Ah, there it is.
Meanwhile, SHLD's own volatility is high at 22.7%. That 3.56 ratio is not sustainable. Once Palantir's growth normalizes, expect SHLD's Sharpe to fall, probably back toward the 1.5 to 2.0 range.
That volatility leads us straight into a paradox in our next section, the beta mystery. SHLD has lowest beta but highest volatility.
Yeah, this confuses a lot of people. So beta measures how much a stock moves with the S&P 500.
Yeah.
SHLD has a super low beta of 0.27. It basically does its own thing.
But its volatility, the size of its own swings, is really high at 22.7%.
Right. So it's like driving a monster truck on a back road. It doesn't follow the highway traffic at all, but it's still a really bumpy ride.
That's a great analogy.
Defense spending is often counter-cyclical. Governments keep those budgets going even in a recession. So SHLD acts as a hedge against the market. It's volatile, but it just doesn't care what the S&P 500 is doing.
Okay, let's review the critical differences in the portfolios here. Next up, holdings battle royale. SHLD versus ITA versus PPA.
The holdings tell the entire story of 2025. SHLD was positioned perfectly. It captured Palantir and Rheinmetall. ITA, meanwhile, which is anchored by GE Aerospace, missed both of them.
And worse, ITA held a big position in Boeing, right? Over 9%.
They did. And avoiding Boeing was a brilliant move by SHLD. Boeing was actually down 12.5% year to date, so that was a huge performance drag on ITA. SHLD captured the winners and avoided the losers. Simple as that.
Something that's never simple is cost. Let's look at the section. Expense ratio war. Every basis point matters at over 10 years.
The cost difference really does add up. ITA is the cheapest at 0.38%. On $1 million investment over 10 years, that's about $40,000 in fees.
And SHLD is more expensive.
Yep, 0.50%, which comes out to about $54,000. And PPA is the most expensive at 0.58%, or $62,000.
So SHLD's fee is over 30% higher than ITA's. That's an extra 13 grand.
It is, but SHLD's massive outperformance this year more than justified it. The real question is, if that performance normalizes, ITA's low cost becomes a huge long-term advantage.
So CTA2, let us know what you think about this in the comments below. Is that concentration risk really worth the higher fee?
Let's move on to how these hold up in a downturn. Next section, stress test. How these ETFs perform when markets crash.
Historically, defense has held up pretty well, right?
Very well. During the 2008 crash, the S&P 500 fell 57%. Defense ETFs, they were only down between 12 and 25%.
And even during the COVID crash in 2020, they recovered much faster than the rest of the market.
Exactly. The key insight here is that geopolitical instability is the best catalyst for these funds. The 2022 Ukraine war caused ITA to surge nearly 89% over the next 3 years.
But there's a flip side. Rising interest rates can really hurt high-growth tech stocks like the ones in SHLD much more than they hit the stable contractors in ITA.
Right, which lets us build the bull and bear case. So let's start with the upside. The bull case for SHLD. Why it could hit $150 plus by 2030. We're giving this a 60% probability.
Okay, so the bull case has three main pillars. First, that $4.2 trillion NATO commitment. That's a locked-in tailwind for a decade.
Second is Palantir's AI dominance. If it becomes the literal operating system for the military and hits $20 billion in revenue by 2030, then its current crazy valuation is probably justified.
And third,
European rearmament. SHLD has 32% European exposure, ITA has 0. So SHLD directly benefits from that huge Rheinmetall backlog. The institutional money pouring in just confirms the momentum.
but every explosive rally has its risks. Let's cover that in our final section. The bear case for SHLD. Why it could crash 25-40%, plus your final verdict. And we're assigning this a 40% probability.
The number one risk here is the valuation cliff. SHLD's overall PE ratio is about 37. Palantir, its main driver, trades at a forward PE of 213.
213, that's what they call price to perfection.
It is. Any earnings miss, any contract loss, and that stock could drop like a rock, taking the whole ETF with it.
And we can't forget that concentration risk. A 20% drop in Palantir would instantly knock 2% off SHLD. A 15-20% drawdown isn't a possibility, it's an expectation with this fund.
So the final verdict, how do you play this?
What are the paths?
Okay, 3 paths. Path 1, aggressive growth. You buy SHLD, maybe a 5-8% allocation. You're targeting an 18-22% return, but you must be able to stomach a 25% drawdown.
Path 2.
Moderate growth, you buy both. Maybe 3% in SHLD and 3% in ITA. Get stability and some of the upside. And path 3, conservative. Just buy ITA. Lowest fees, proven record. It's a sleep well at night choice.
And what about PPA?
Avoid PPA. Highest fees, weakest performance. It's a non-starter. And a final reminder, CTA 3. Subscribe today for more in-depth research.
Okay, so we've broken it all down. Defense tech stocks are seeing this incredible, explosive growth thanks to massive NATO spending. But it's all wrapped in extreme concentration and high volatility.
Remember that beta paradox. SHLD's low beta hedges you against the S&P 500, which is great. But its high volatility makes it super unpredictable on its own. The core question for you to answer is this. Can you stomach a 20% drawdown for a potential 20% annual return?
Or do you prioritize the stability and lower fees of ITA?
That's the decision you have to make.
Thank you for joining us on this deep dive into the defense sector. For more expert analysis, check out the rest of the ChannelVest deep dives. We'll see you next time.